Welcome back to Morning Markets on Thursday the 5th of October. We've seen some volatility in the markets recently, and today I would like you to join me for a brief update on some of the reasons behind this. I've also got an important and related development in respect of the US labour market. Please stay tuned to find out more. Integral to the moves in global multi-asset portfolios is the yield on a US government bond, which this week hit a 16-year high. For context, let's cast our mind back to 2020 and let's work forward to some of the key developments that we've seen in the bond markets. Yields have been rising, not just in the States, but globally since the summer of 2020, on the anticipation that at some point interest rates were going to have to move from their zero bounds, on the expectation that we would see inflation come through. We certainly did see inflation come through at a rapid rate, and at that point central banks were responding by raising interest rates at an aggressive rate. Higher interest rates are a challenge for the bond yield. Bond yields move higher. Bond yields and price move inversely. So as the yields were going up, prices were coming down. So it negatively impacts the price. It also impacts equities because of the way in which we can value a company, applying a discount rate to future earnings. A higher discount rate means a higher impact to the valuation of the company. And it can also impact currencies if we're seeing a differential in terms of interest rates internationally. Now, since the summer, markets have become more comfortable that inflation has peaked, the rate of inflation has been cooling, and we may have even potentially seen the last interest rate hike in the US, which was easing quite materially some of the headwinds that we were facing through the course of last year. And this has been particularly reflected in shorter maturity US government bonds, which are more sensitive to interest rates and have therefore been trading in a narrow range since the summer. But more recently, what's the change? Well, its markets have been surprised by the strength of US economic growth. This has been fueled by very strong labour markets, but also fueled by higher oil prices, which we've seen more recently. And all of these aspects coupled together present a challenge to the rate in which inflation can slow. So disinflation, which we're expecting to see in the markets. And this means that potentially interest rates, rather than being cut in the US next year, may have to stay slightly higher for longer. The Federal Reserve have acknowledged this themselves. Rather than expecting 100 basis points of interest rate cuts next year, they're projecting just 50 basis points. Adding fuel to this move in the bond market has been Biden's fiscal spending plans, so government spending plans, and the need to issue more bonds in order to support that spending, which has been pushing the yield up on long-dated US government bonds. So this combination has presented a challenge for the bond market and therefore equities. But yesterday we saw some data which was easing one of those components. It was the labour market dynamics which Paul Durrance discussed yesterday. We received the ADP private jobs market report. It demonstrated that 89,000 US citizens secured jobs in the private market sector in September. But this was relative to an expectation of 158,000, so it was quite materially weaker than was expected. And it might seem counterintuitive that you've got weaker labour market dynamics giving upside surprises to the markets. But essentially what this is doing is it's easing the pressures around wage growth, but also potentially the ability for consumers to spend at their current rate. Coupled together, eases the pressures on inflation. And the Federal Reserve have acknowledged this themselves in their projections, that unemployment levels need to tick up slightly and employment conditions need to cool to help them in their battle of getting inflation back towards the 2% level. The reaction in markets was therefore positive. We saw US bond yields move lower. We saw equities, which were positive in US dollar terms. But if we look at this in terms of sterling terms, because of the dollar weakness, sterling strengthened and the translation effect moderated the uplift for sterling-based investors. I do hope this provided you with some context in terms of some of the moves that we've seen in recent weeks and months, but also an important update on the labour market from yesterday. Thank you for watching.